Good day, my name is Dean Crocker. Thank you for joining me, and I'll be taking you through our latest EI report completed on Glencore. So on the 18th of March 2021, Glencore released the full year 20 results. The group recorded a substantially higher loss, basic loss. This was really attributable to COVID-19 associated weaknesses and a significant non-cash impairment of certain coal and oil assets, which totaled 5.9 billion. The benefit of this impairment is that for future periods, you will see an improvement in a lot of the ratios, as effectively you're going to continue generating more or less the same type of returns, particularly on an income statement basis relative to a lower balance sheet. So therefore, you've actually artificially increased your ratios going forward. Now, one thing about Glencore, which I found quite interesting, is that it's a nice business in the sense that it blends your traditional mining house with a commodity trading business. And effectively, a commodity trading business, which is their marketing division, contributes roughly about 30% to their EBITDA. So just in terms of results, they benefited from strong commodity prices across the board, barring your lower coal prices and effectively the energy segment within the industrial sector. Underlying EBITDA remained relatively flat, 11.6 billion, but there was a sizable impairment of those oil and coal assets. And in a basic standard, they incurred a loss, which was quite sizable. However, adjusting for that impairment, headline earnings were only 10% lower at $2 billion. Cash flow, and it's not recorded on this slide, but free cash flow did improve by 65% to roughly $4.3 billion. And off the back of that, the group did propose a dividend per share of 12 cents per share effectively. In terms of the free cash flow, it also allowed the group to reduce their net debt, which reduced by 20% to 15.8 billion. And in terms of an EBITDA ratio, that's about 1.3 times to EBIT. Now, one thing that does concern us, and roughly around about the net debt, is in the next 2 years, they have quite a sizable amount of debt that needs to be repaid. And if I remember correctly, that was roughly about 2 billion in full year 21, and then a further 8.7 in full year 22, which relative to free cash flow of only about 4.3 billion, it does pose a bit of concern for us. The group has emphasized that they have significant committed liquidity, which totals roughly about 10 billion, which they can use to settle this, but it does kind of show that they have a lumpy debt repayment right now relative to quite a strong free cash flow period, which is still not sizable enough to offset that debt. Just in terms of the impact, on date of release of the results, the share price did close 1.31% lower relative to JSE Capped, which closed 1.5% lower. Now, despite both being lower, it is seen as a positive reaction by the market. And since the beginning of the year, Glencore has outperformed the benchmark by a nice 19.8%. And it brings its year-to-date return to roughly 37.6%. In terms of the valuation of the business, on an EV/EBITDA basis, the group is trading at a slight discount to its 5-year average of 5.9 times, but it remains at a significant premium to its FactSet peers. And those peers, for everyone's benefit, is relatively BHP Billiton and Anglo American. So relative to itself and its 5-year average, it does seem to offer value. However, relative to its peers, it is seen to be very expensive. One thing that should be considered is these results reflect your higher commodity prices, and the share price effectively should also imply or reflect the higher commodity prices. So on the back of that in consideration, and you'll see a few of the more steps in the assessment, we do feel that the share is probably fairly valued at present. So in terms of the assessment, so Glencore is trading on results that are backed by seasonally high commodity prices. There was some impact seen in the energy sector, particularly in terms of the coal assets. Really so in South Africa, where a lot of the coal assets actually did not perform well at all, and there were some closures. COVID-19 also impacted a lot of the production, so you didn't see much coming through from the coal sector, and the price is also quite weak in terms of coal. Copper, however, which is one of the Glencore's stronger core commodities, performed very well, and should so continue to do so for the next few periods. It should be noted that the results were for the end of December, and we are already kind of at the end of June now, which implies that they've had significantly higher coal or significantly higher copper and commodity prices for the first 6 months of the financial year, which should really support their earnings for this period. The question is what happens to commodity prices going forward, and if they weaken, it will definitely impact the share price, and as well as the benefit or the performance of Glencore. So the group is currently trading at seasonally high commodity prices. They have had very strong cash flow generation, which allowed them to pull in line their net debt to a certain extent. They're also trading at a very low EV/EBITDA multiple, but that is also a function of the higher commodity prices and effectively stronger results. The group does offer the benefit of diversified mining operations, and as I mentioned, then you also have the upside of the trading business, which is roughly 30% of the EBITDA. So the group still remains very well placed, and as I mentioned, they've had 6 months of higher commodity prices, so they remain well placed to benefit from the higher commodity prices, particularly coal, and then copper and coal. Coal is expected to make a recovery following the COVID-19 restrictions and the lifting of them, and that is particularly how we expect that the South African operation should benefit from this. The one concern is that commodity prices, and there's a lot of speculation in the market that they might be quite high. So any rapid downward re-rating of commodity prices will have an immediate effect on the share price as well as the counter. We do feel, however, that the share price adequately reflects a lot of those risks. The share price also definitely reflects easy money, however, so the higher commodity prices. And to grow off the high base that they're currently at might be quite challenging. If they're able to maintain the existing production numbers on the higher commodity prices, you can expect to see significantly stronger results, and that will play straight into the hand for capital expansion going forward. But there's, in our view, the downside is just a bit greater right now than the upside, which adds that element of concern to our valuation and also to the current share trading price. And on the back of all of that, we feel that the current share price is probably neutral to an underweight, and on the back of that, we recommend that the portfolio should be an underweight. If you'd like to place a trade, please speak to your financial advisor. Alternatively, the trading desk would be more than happy to help you. Please take note of the disclaimer and have a good day.